Hey everybody, welcome back to the channel. In this episode, I'm giving you 2 hacks to help you successfully enter a stock position. Let's go. Okay, so one thing I've personally found to be very difficult is to enter a stock position at the right time, meaning it goes up after I buy. We're all familiar with the old buy and drop experience. All too familiar, actually. So what I've decided to do is show you my 2 hacks that allow me to mostly eliminate this buy and drop phenomenon that seems to plague most of us. As always, if you like this video, hit that like button, and if you're new to town, consider subscribing. We'd love to have you on the Taking Trades team. So after you've done your due diligence and you've found that one shining stock that you definitely want to buy, how do you go about taking an entry? Well, let's talk about strategy number 1, which I'm going to call get paid to wait. So this involves what is known as selling a put option. A put option is a contract where you pick a specific price and a period of time. For example, you could pick a week or maybe a month. Now, what happens is if the price of the stock drops below the price level that you picked and the period of time you chose runs out, then you get assigned these shares, just meaning you were obligated to buy these shares at this price that you chose. Now, here's the thing. When you enter this contract, you get paid money up front called a premium. This is a per share payment to hold the contract. No matter what happens from here on out, you get to keep that premium money. So this is the get paid to wait part. Now, here's a visual example to help you understand.
Okay, so we've got the whiteboard up here, and I want to explain what exactly a put option is. When I say sell a put option, what I mean is you pick a price that you think is ideal for your stock that you want to purchase, and you pick a time frame. And what you're saying is you will agree to buy this stock at a price that you choose at a time frame, at the end of a time frame that you also pick. So let's just say, for example, you pick 1 week. That's our time frame. That's our expiration. 1 week. And let's say that on a certain stock that's been moving around, you decide that $10 is the perfect place to get in. That's what you're willing to pay on this stock. And $10 is right in here. So you're watching the stock, you go ahead and you sell a put option, you pick a $10, what they call strike. I'm going to write that right here. So the price you choose is the strike, and you decide that a 1 week time frame is ideal. So what you're going to do is as this stock moves around, let's say that by the end of the week, it's right here, just below $10. So what this means is that you got assigned shares and you now have to buy them at $10. You're obligated to buy them. So typically people will wait, and let's say this stock was trading for $12 up here. It showed a lot of strength, people got excited, and they bought right here. We've all done it. I've done it, you've done it, and then it pulls back. And now you're in the red and you're hoping it will come back up. So rather than sit through this pain, what I'll typically do is I will sell a put option. I'll pick a time frame like a week. I'll pick a strike, in this case $10. And if this stock price action meanders below $10 and stays there at the expiration, which is on a Friday at the close of the market, then I'll be assigned the shares, and now I just got a really good price on a stock that I'm interested in. Now, for example, let's say that the stock then comes back down towards $10, goes below, and then ends up expiring back above $10. You don't get the shares. You don't get assigned shares, and you just move on. But here's the kicker. Let's say your premium, you remember I talked about premium. Let's say you're getting paid $1 premium. That means $1 per share, and one contract is 100 shares. So that means that you would get paid $100 to enter this contract, and no matter what, this $100 is yours to keep. No one can take that from you now, no matter what happens. So you got paid $100, and now you're just waiting for your time frame to expire. If your time frame expires below $10, you're going to buy 100 shares. If the time frame expires and the price action is above $10, then you don't get the shares and the stock just moves on without you. So that's the risk. You might not get the shares at all, and then you'd have to be buying a lot higher. So you'd have to wait for another pullback or another dip. So this is why I say it's a buy and wait strategy, because you're saying, okay, I understand that it's at $12, but I'm not going to pay more than $10. So you set up the contract for a $10 strike. You get paid a premium. Could be 20 cents, could be 30 cents, could be $5, whatever. $1 just an example. And being that one contract is 100 shares, you're going to get paid $100 to wait for a week. And then you see the outcome. Let's say it doesn't go below 10 and it goes on without you. Well, you miss out, but you keep your $100. No one can take that $100 from you. So it's a great way to make money up front and then possibly get a really good entry on a stock that you've done your research on that you really want to be long.
So not only do you end up with the stock you're after, you just got it at a lower price and you got paid just a little bit to wait. Now, one thing you need to be aware of with this hack is the fact that options contracts involve 100 shares per contract. So you have to make sure that your stock price makes sense with regards to the size of your account. Now, on to hack number 2, which we're going to call nibbling shares. This is a slightly simpler approach that I use to get cozy with a stock that is very easy for you to execute. This one involves buying a small amount of shares each time the price of a stock has a pullback. So let's say your stock has a down day. What I do is I watch the stock the following day, and if it goes red again, I keep waiting. And I follow up the next day. And when I finally start to get a green day forming, I nibble a small amount of shares. Some people call this buying the dip, and it's a super helpful way for averaging into a comfortable position within a stock. I feel like it protects me because if I nibble a few shares and then the stock drops hard, I just wait until I start to get that green day before I buy again, and this will average down the position that you already have. I recently did this with Facebook, and I'm currently up on the overall position. So let's flip over to the charts and I can show you my Facebook example.
Okay, so I want to show you real quick the Facebook example that I was talking about. This is a position that I currently hold, and what I had done was Facebook had this big pullback, and then another one, and then this third one, and I went ahead on this green day, I went ahead and nibbled a few shares. Now, the upside is with no commissions on TD Ameritrade or a bunch of other platforms, it's super appealing because now I could buy one share every day if I wanted, and it costs me nothing. So what I did was I started buying 10 shares here, then I bought 10 shares here, and then I bought 40 shares here, and then I waited, and I got this big sell-off down here, and then this big push up, and on this day, I went ahead and added more shares. So overall, with 4 different pickups, I bought, I ended up with 100 shares total. Now, I was buying higher and buying lower, and as you can see over here, if I open up this window, you can see that my average price on this is $180, right in that area. And you can see that right now Facebook is at $104.19. So because I nibbled high and I nibbled low, my average cost is $180 because I took my time limping in, and right now I'm up almost $400 on the position. So it's a really good way of minimizing your downside because you can nibble and wait. If it goes up, just let it go up. Wait for the next pullback. If it pulls back, nibble a little. And just keep going through that process, and you'll get a really cozy average cost or your average cost basis, which will really make it easier on your nerves so that you're not as emotional. Because if you just jump in with 500 shares, you know, the stock could drop $3 right away, like intraday, and then you might be really sweating things. So it's a great way of casually limping into some stock and letting the stock move and sort of averaging in. It's worked really well for me. It's helped me be more comfortable, and I think it can help you be more comfortable as well. So this is just an example with Facebook.
So there you go, 2 hacks to make sure you get that perfect position you've been looking for. Thanks for stopping by, and we'll see you next time.